All right, everybody. Sorry about the little delay there. I'm ready to go. Welcome to Trading Coaches Playbook. My name is Brandon Wendell, and I'll be your host for the next, about an hour, I guess. So, welcome, everyone. We'll go ahead and kick this off as we usually do with a quick reminder. We're not broker dealers or investment advisors, so we're going to be looking at this information here from an educational standpoint. We're not telling you to buy, sell, or hold anything in particular. Giving personalized recommendations about the markets. All markets do involve the risk of loss, and that's always a situation. We can never eliminate the risk. We can just try to minimize and manage risk. We're also not subject to trading restrictions. We got positions in securities or initiate them at any time. And we are very busy here. As you can see, a lot of stuff going on. You see a bunch of premium online workshops that you more than welcome to join us. We got the mastermind group, E-mini think tank. I actually have a Q&A coming up on September 4th as well. But with the E-mini think tank, I meet on a regular basis Monday, Wednesday, and Thursday from 9 to 11 a.m. to practice a lot of the technical analysis and trading strategies that I teach on a long-term basis. So it gives you an opportunity to learn as well as execute under the tutelage of myself as a trading mentor. I've been in the markets for about 30 years now. So I've been doing this quite a bit and pretty successful. I enjoy sharing my knowledge with people and helps me to become a better trader, to be honest with you. So it's not just for myself or not just for other people to help them, but also for myself. It's going to be to become better as a trader. And, sharing information and ideas with people is always a good thing to make sure they sound right. Even reading it back to yourself. We'll talk a little bit about some of the trader psychology stuff that you can do to help you become better as a trader. And my main focus today, I was going to talk a little bit more about risk management. I did this presentation once a while ago, and I'll bring it up here. We have tuning the risk radio. And it doesn't matter what you're trading. My mentor kind of equated it to tuning a radio to be able to adjust your risk, because whenever you are looking at the markets, you can't control whether you're going to win or lose. I mean, it'd be nice if you could, because obviously you try to win all the time, but you can't control that. All you can really control is how much you're going to lose if you happen to be wrong. And that's one thing that we have to maintain, is that amount of risk that we're comfortable with based on the amount of capital we have in our account. And everyone's a little bit different psychologically as to what affects them emotionally and possibly even physically when it comes to losses. For some people, depending on the size of your account, a $10 loss could be very detrimental, and for other people, that's cost of doing business, no big deal, you shrug it off. And we need to figure out, what's right for us. There's not one setting that's going to be perfect for everyone. You've got to find out individually what's best for you. And it's been a while since I've gone through these, but we'll do quick introduction, talk about risk management, what it is and what we can do about it, how it works in the real world when it comes to trading, and how you can learn more. Where would you find additional info to help you out in managing your individual risk in the markets? And I found this quote a while ago. Large losses are forever. Investing in teenage driving and infidelity. If you avoid large losses with a strong defense, the winnings take care of themselves. And large losses are almost always caused by trying to get too much by taking on too much risk. And again, it's the same thing in life as it is in the markets. I mean, markets are life, part of life. But yeah, it really does affect us. I mean, there's only so many outcomes you could possibly have to a position. You can have a large win, break even, small loss, and large loss. And if you get rid of those large losses, everything else kind of takes care of itself. And we focus way too much on trying to get big wins when we really need to be focusing on keeping small losses small, because every large loss started off small. And the problem is that we ignored our stops, or we thought, it's going to come back. It's no big deal. And we allow those small losses to mushroom and grow and fester into large losses. And they crush our accounts. So I'm not going to talk about myself too much. I'm a former broker. I became a hedge fund trader for a little while. I've actually traded for the back office and brokerage operation as well. And I've been teaching since 1999, I guess. So I'm my 26th year of teaching, trading, and investing. So I've been doing this for a little while. And it's funny because A lot of people want to focus so much about what's going on the screen and the technical analysis, but what's really important to become successful at trading is working on what's going on inside your head and the way you perceive inputs, both positive and negative, in the markets. And I can't overstate how important that can be. It comes down to some simple little things even to make you better as a trader, making sure that you have good natural light, but maybe not on the south side of your house where you're getting beamed by sun all day long and getting worn down. We want to have, like I said, good natural light so we're awake and alert, but not cooked, so to speak. Little things like making sure that your monitors are lifted slightly upwards. So when you have to look at your monitors, you actually have to lift your head slightly. It keeps you more alert and more positive. A positive person is chin up, shoulders back, whereas a negative person will be slumped down. And a lot of us end up slumping down over keyboards all day. We don't want to do that. So again, we'll jump into this. What is within your control? I kind of mentioned this already. We cannot control whether we will win or lose in any given position. We can't control the direction of the market. We try to predict and identify the potential direction of the market, but it is beyond our control. We cannot influence it one way or the other. If you can, please get in touch with me. Let me know. We'll make lots of money. So, what is within our control is how much we're going to lose if we are wrong and when we are wrong, because it will happen. And, my mentor kind of equated it, as I mentioned. And yes, I had a mentor. I think that's a very important step that everyone should have a mentor that they can communicate with and receive feedback from to make them better. I'm wearing my referee shirt actually. I was out there refereeing yesterday at a high school game and I was working with a junior referee. I'm more senior than them, but I even said to them, I'm continuously trying to improve. So while they were looking to me for feedback, I also turned it on them. I said, listen, if you see something that you think I do that could be done better, or you're wondering why I do certain things, ask and let's find out. And how can we improve ourselves to become better? He said he graded himself a C on his last outing, and on the current outing when we were together yesterday, he gave himself a B. I said, I think I would give you an A minus. To be honest with you, you're pretty tough on yourself, and we are. We're our own toughest critics. But he improved, and because of the fact that he was willing to take on constructive criticism, and for us, we don't always have that unless we have a mentor we can work with. If we're by ourselves, the only thing we can do is try to go back and look at the trades that we have taken and figure out, okay, what worked and why, or what didn't work and why, and try to improve ourselves from that. So when it comes to the risk radio, we have the old boom box here with the dials on them, and you got to tune the radio. So obviously we got frequency as one of those, and we'll go over the different dials that we can actually control. The biggest one, however, is volume. And I'm not talking about loudness. I'm talking about the number of contracts, the type of contracts. I mentioned I trade futures primarily. I also do a lot of options as well. But when it comes to futures in the E-mini think tank, and thank you, you can see there's some of the classes there. If you're interested, you can try it out for free. I do a 2-week free trial with quarterly subscriptions. But when we're dealing with different types of contracts, the nice thing is, if I go out to, let's see, bring up a browser here and go to CME Group. And for instance, I can click on gold if I find it. There we are, gold. It's right here. Find the right gold product for you. We have gold futures, micro gold futures. We now have 1-ounce gold futures. There's also E-mini gold futures. There's gold options, micro gold options. So we have a lot of different products to choose from. So volume, if you turn down the volume, you're now using smaller size. And you can see that we're trading a notional value of $3,400 of gold, only 1 ounce, with a margin of $150 versus trading $340,000 worth of gold, or 100 troy ounces, with a margin of $15,000. Well, obviously, the lower volume, lower size is going to have less risk, as well as less margin requirements, and less reward. Those will be smaller as well. You can see we got kind of in between right here, and then also micros on the smaller side. And it shows you, this is your risk and size of the contract. Large risk, large size. Small risk, small size. Very small risk, small size. And medium risk, medium size. And the same thing with the options. Full size options are much more risky than smaller and the micros. And we can choose the amount of risk we're willing to take by dialing up and down the volume. Now, volume also has a little section all the way down called simulated. And everyone, when they first start trading or start trading a new contract or new security or a new asset class you haven't traded before, or even a new strategy, should probably try it out in simulated mode. But you got to be careful. Okay. In simulated mode, you do not lose any money. It loses simulated money, but you can always reset that. So you do not have the same psychological impact when it comes to losses in a simulated account as you do with a live account. So to me, simulated trading, the biggest benefit is to be able to learn the software and the mechanics of placing the orders. It does not represent simulated trading per se, because you are not going to be as psychologically affected by a simulated loss as you are with a real loss. And that's why it's really nice that we have the micros, because even if you have a larger size account, don't jump into full size contracts right away. Start trading in the micros and the 1 ounce contracts, wherever it is, something small, because now when you lose, you're actually losing real money. And when you start losing real money, even though it may not be a large amount, it's still a loss. And you react differently. It's saying true. Absolutely. You start finding out where your body actually sweats, where in your body, right? You might not have realized it before. So, yeah, there's a big difference to me. I want to be in simulated mode, like I said, to practice new software, to practice placing the orders to get the mechanics right. But as soon as possible, I like to switch to real contracts, just a very small size, whatever the small size could possibly be. This volume button is probably the most important button you have. At any time when you run into problems, and it happens, we go through slumps, we go through streaks where we're doing really, really well, and then nothing seems to work. When you hit that point where nothing starts to work or you're having some struggles, tune down the volume. That's the first one you should touch. Reduce the amount of risk. The psychological problem that many people have is that they actually try to double it, turn it up. Oh, if I I've been losing. If I double it now, I can get it back quicker. No, you just traded a shovel for a backhoe, and you are digging your hole even faster and deeper. Okay, we got to stop digging the hole first. I said it out of order, but there's Will Rogers, the American humorist, once said, "The best way to get yourself out of a hole is to stop digging." And that's what we need to do first. We stop digging, figure out what's wrong, fix it, and go back. But now we're going to start digging with the teaspoon rather than the shovel, because we're going to go back in. And here's the neat thing about this. Let's say I was trading normal size contracts of the or E-mini S&P 500. Okay, that's what I was trading, maybe 3 contracts of the E-mini S&P. When I go back to trading after having some losses, if I dial it down to micros and I'm only trading 1 micro contract, I cannot possibly get back the amount of money I lost on a 3 E-mini contract position size, can I? I mean, it'd be very, very difficult for that to happen. The reason why I do that is I'm not trying to get the money back. Okay, that's gone. That money was lost. It is gone. Any money I get now is new money. But what I need to do is build my confidence in my trading plan and my techniques and my strategies. And I need to do that without thinking about trying to get the money back. Revenge trading doesn't work. Believe me, I've tried it. Okay. I'll even stop trading certain securities if I have a bad streak on them and just avoid them for a while if I need to. But yeah, revenge trading doesn't work. And one of the best ways to avoid that revenge trading is to make it impossible for you to get it back by dialing down the size, trading micro contracts if possible, or less number of contracts. So even your wins will be wins, but they're not going to be as big as what your losses were. And you're not trying to dig your way out of the hole yet. You're trying to build a good foundation to start climbing forward, onward. Well, the next dial is frequency. Okay. And with frequency, it is how many trades are you taking? Actually, yeah, okay. And that's based on your strategy. One of the things we have to figure out when it comes to trading is what kind of trader do we want to be? A lot of traders uh, do it part-time. There's nothing wrong with part-time. You just got to make sure you take trading seriously and do the preparation you need to find the right opportunities. But you don't have to trade every day. You can be a swing or position trader where you get in a position every couple days or every couple weeks and just manage them actively if you need to. Some people enjoy being a scalper where they're firing off trades every other minute, in and out quickly. And it's going to be based on your strategy, but the more frequent you trade, the more risk you are inviting. Just like volume, the higher you turn it up, the more risk you have. And the last dial, and I'll go into all these in more detail, of course, that is duration. That's kind of hand in hand with frequency. And we can actually adjust them because a lot of people say, well, scalping is really risky because you're taking a lot of trades. Not necessarily, because your duration is very small. And with a small duration for your trade, you have less time for prices to go further against you. Whereas someone who might only take a few trades a month, if they're holding on long term, those trades could be catastrophic if the prices go deeply against them. So again, starting off detailed again with these, I started going over volume already a little bit, but again, the higher the volume, the greater the risk. We need to protect ourselves. And starting off simulated, you have no risk other than time, right? You're taking your time to do the simulated trades and you're practicing, but there's zero risk in dollars. If we take small size, now we have smaller risk, but we actually have real dollar risk. We start feeling things psychologically that we may not have felt before. You become more emotionally attached. I know I'm attached to my money, maybe not as much as my wife, but we are attached to our money and we don't like to see it go. They say money talks. Mine usually says see you later. But anyway, we just got to ease in. Even if we're willing to take on larger risks, we shouldn't do it right away. We should ease into those larger position sizes. And of course, as any time we run into struggles, I said it before, dial back the size to protect yourself. And we do not need to go 100% leverage, and we should not ever go 100% leverage. We need to make sure we hold something back in case of a black swan or catastrophic event. They happen. Sometimes the markets go dramatically against us based on news or a Truth Social tweet or Twitter or whatever it may be. Things happen and news moves markets quite a bit. So we need to be very cautious and make sure we're prepared in case things go against us. We cannot do that if we leverage ourselves 100%. And I said this before, at any time, if you're struggling, turn down the volume. That should be your first turn when it comes to your risk management. You're not getting your losses back. Focus on your techniques. Make sure you're doing well and following your rules. Figure out what you did wrong, fix it, and then move forward from that point. So I said you can control your size with selection. With stocks, you can choose the number of shares. You can scale into positions. You can also scale out of positions to reduce your risk exposure. Even what you trade. There's something called beta, which measures the amount of volatility versus the broad market, the S&P 500. You could trade higher or lower beta stocks. And higher beta stocks might have more risk because they move further and faster, both with or against the broad market. So your losses might be magnified along with the risk and rewards. ETFs, again, you can reduce risk as a stock trader by trading ETFs because you're reducing single company risk. And by doing that, you're trading a group of companies rather than just one. Typically, individual ETFs will not have the same type of rewards or risks as individual stocks. Again, it's all relative. If you're trading currencies, obviously lot size is totally adjustable. You can choose standard, mini, micro lots, and you can even choose more volatile securities or less volatile securities. Take a look at the average true range to give you an idea of what's volatile and what's not. They have nicknames. The euro yen is called the guppy. It's a little guppy. It's not going to hurt you that bad. The pound yen is called the beast. You think that might be a little bit of a problem? When it comes to options, we can control our option size and number of contracts. And the nice thing is now there's micro options available in a lot of securities, especially if you're trading options on futures. You can trade options on micro futures rather than the full size contracts, and you can control your risk that way. And of course, with futures, we have plenty of choices: e-minis, standards, micros, all different kinds of contracts that we can trade. So we can control our risk. Overall, higher volatility, higher risk. You can check the ATR, you can check margin rates. If there's higher margin required to trade something, you better believe it's more dangerous. The margin's there for the brokerage protection. They make you put down deposit. That way it covers your losses. They don't have to come after you for those losses if you have them. So moving on to frequency. The only one who wins more when you trade more is your broker, because they charge you more, right? You pay commissions, you pay fees. So the more you trade, guaranteed, the more they make. Of course, you can negotiate fees and things like that, but still, there's no guarantee you're going to have profitable trades by trading more. And as a trader, our job is to select the best opportunities and take those. Now, could it be 10, 15 trades a day? Sure. If they're all high quality that meet up to your criteria, your strategies that you've set, then that's fine. Okay. That's not over trading. If you follow your rules, you evaluate the individual positions and they meet the criteria, that's not over trading. To me, over trading is throwing in positions without having fully evaluated them, knowing that they match up to your standards and your criteria that you need before you enter. So be selective, be choosy. Don't swipe right on every trade. We want to make sure we find the right trades, and we need to have a plan for this. If you're not trading with a trading plan, shame on you. You should have a written trading plan, or maybe typed out on your computer if you want to. I prefer writing because it also creates muscle memory as well. But yeah, I have it both ways. I have it on my computer and I have a written plan. And if you have written plans that deal with different market conditions, you're going to be much better prepared for whatever might come your way. And markets change. I didn't look, I was actually busy this morning, so I didn't see. If I go out to, let's see, Forex Factory, what happened with the PCE number today? Were we inflationary? Were we not? That's the big thing everybody's looking at today. So we go out here, PCE, and it came right in line with expectations. Now we have a negative goods trades balance, but that wasn't a big number everybody's watching. And we also have a little bit worse consumer sentiment numbers, but this is an inflationary number that everybody was watching today, along with the GDP numbers yesterday, to give us an idea. You see right here, they're talking about it to give us an idea of how the markets might react. And let's see, I'm on a different page here. I think we reacted pretty negatively this morning. The S&P futures at 8:30, we actually went positive, but then the open, we just sunk right into a bit of demand here. But have a plan for different market conditions. Is the Fed likely to be cutting rates? Is it not? What is the market going to do to react to that? Have a plan. Understand when we're in inflationary times or we're in deflationary times, and the difference and how things are affected. Follow the plan. That's another thing. It's great to have a plan, but it's useless if you don't use it. What is it? Mike Tyson always said everybody has a plan until they get punched in the face. Even football, the first 10 to 15 plays in the NFL are scripted before they even kick off. Okay, both teams have a plan of what plays they wish to run and how they wish to control the tempo of the game. Now, it changes when things happen, but at least they start to having a plan. They try to follow it as much as possible because the more you can follow your plan, the more you can identify the probable outcome of the markets and have the opportunity. Have a trade limit. Know when to quit. It could be 3 trades. I used to do 3. If I ended up wasting my third trade, and by the way, that third trade, I tried to wait and make sure and evaluate to make sure it was a really good trade before I took it because I knew it was my last one of the day. And if I found that I wasted those trades, I felt stupid and I had to be disciplined not to take another trade, even though I could. Nobody was going to stop me except myself. But if you have a limit, that means you're going to be a little bit more cautious with utilizing your trades rather than just taking any trade that comes along. One of the things that we do in the E-mini think tank, let me see if I have it open here. Yeah. If I go over to, it's loading up. E-mini think tank. Imagine there's a lot of education and practical application. And the nice thing is I just redid all the education. So you've got all these new trainings, new videos that are out. I'm organizing everything now. And in the tools, there's also documents here for us that support all the education. And I believe, there it is, trade scoring worksheet. We actually have a trade scoring and tracking that we go through to help us identify, is this a trade that we should be taking? And if it is, what type of entry should we be taking? If we're following that on a regular basis, then we have a higher probability of taking good trades. And Tripp saying something great. I used to have 3 strikes in your out, but I also stop at 3 wins. Yes. You know what happens? A lot of us get that Midas touch. We think that everything we touch turns to gold. And if we keep going, we get a little too cocky and overconfident. I know it's you got to know yourself. And I do that. I'll get a little too cocky and then everything starts to turn into mierda. So so yeah, have a trade win limit too, not just on the loss side, but just in general trade limit. Whether or not they're wins or losses, know when to quit. They say go out on top, right? Quit when you're ahead. I was reading a bunch of articles. I'm a huge soccer fan, so I was reading articles today about Jose Mourinho, and they were talking about him and Pep Guardiola. And if you're familiar with the football, true football, not American soccer, whatever, they were saying that they should have retired, packed it up because they're beyond their prime. They're not as good as they used to be, perhaps. And Jose Mourinho got fired basically from his most recent team in Turkey that was coaching, and they're saying he might go somewhere else, but other people are saying, you know what, just go out. You're done. You won a lot of trophies. You're good. And we got to be careful. We get a little too cocky. Yeah, man, I've been winning and winning and winning. I'm getting tired of all this winning. This is great. And next thing you know, you start losing, and wondering where it's all coming from. So make sure we have a limit. Know yourself more than what you know about the markets, perhaps. Again, that our biggest enemy is not the market, it's ourselves, and understanding what we're doing and how we can overcome those deficiencies. I used to work with a trading psychologist and never fan of Mourinho, me neither. Yeah, you either love him or hate him. Um, anyway, there's some good quotes from him, though, that's for sure. He's giving some good TV bites. Anyway, yeah, he's looking for a job now. He'll find something if he wants, I'm sure. So have certain strategies. I love trading trending markets. That's my thing. Some people like trading sideways markets. It depends on the type of trader you are and have a plan for different environments. Markets go through different environments and different conditions. Sometimes we're trending, sometimes we're not, sometimes we're high volatility, sometimes we're low volatility. Understand the conditions of the markets and the strategies that best work for them. And if you're trading the trends, know how to identify the trend properly for the time frame you're trading, when it gets weak, when it gets strong, how it's going to end. Again, in the E-mini think tank, if I go back to the lessons here, in some of the trading I have, supply and demand, but I also have right here trends, trend troubles, identifying stops, and even identifying the right time frames for trading. There's lessons on all of those, and there's documentation that supports that and helps you with that information. And of course, on a regular basis, we get together and we trade 3 days a week, simulated trading in the live markets to employ these strategies and see how they work and how we need to be adaptive with those markets. So if we have sideways choppy markets, there's some great opportunities. You can use some options opportunities to trade time and volatility rather than directional moves. You can even do that with certain securities as well. What are you going to do about earnings season and news that's being driven right now? There are opportunities for that. And black swan or special circumstances. We have certain patterns that we trade on the markets every single day in the mini think tank. We have what is called ORBO, opening range breakout opportunities that work pretty well. There's news information and certain ways of trading. And again, there's all that's detailed. For instance, right there, news trades, gap plays. I think I have, yep, there it is, ORBO. So there's lessons and documentation to support those lessons. And there's also recordings of the classes on a regular basis because we meet 3 days a week and we track everything we do. So we have trade ideas that I put out on a regular basis, and you can track them along with us to see how are these strategies working? Are they the ones we want to be using? Do we need to tweak them? Do we need to figure out what works better? Are we in a different market environment? So the last channel or not dial, excuse me, we had frequency, volume, and now duration. Duration is how long you will be in the markets. Whenever you are holding an active open position in the markets, you have money at risk. Okay, it could be money that you were already making. It was a paper profit or unrealized profit that you could give back if you don't lock in the profits, or it could be an unrealized loss. But you have money at risk if you have an open position. If you have no open positions, nothing's at risk, other than you're missing out on opportunity. Overall, lowering your time active in the markets will lower the overall risk that you're taking in the markets. But whenever you lower risk, you lower rewards. You can't have one without the other. They go together. But just be aware that sometimes lowering the duration is a good thing, not necessarily a bad thing. So lowering your time frames is one way of lowering duration, because basically when I trade, I am trading for prices moving between zones, what I call zones. So for instance, I'm in a 15-minute chart here, and I might have identified an area of supply or selling pressure up here, or even back here, there's another one. And I would target my nearest area of demand or buying pressure. Yeah, this one's kind of used already, but oops. In this 15-minute time frame, we can see the risk would be the size of the zone if we're buying at one or selling at one, and the profit would be the distance between the two. Well, in this case, we're looking at about 40 points on a 15-minute chart. If I were to go to a 4-hour time frame now, the zones will be wider and further apart. So that automatically gives me more risk. Right? The zones are wider than the orange and they're further apart. 57, 14. So instead of what it was 40, now we're looking at 55 or so. So much more risk and more reward potentially by going to a higher time frame. So the duration can be controlled a lot by the time frame you use on your chart. I can take this down even smaller into what we call tick or share bar charts, where the candles are not based on time, they're based on number of trades that have occurred or number of contracts or shares that have been transacted. So we can control that duration by narrowing it down to smaller, or increase the duration, which increases our risk and reward, if we're comfortable by going bigger. So I just said this, lower time frame charts usually have smaller zones, so less risk. But you have to decide what you want to do for yourself and you find the right combination. Even if we're taking on less risk in duration, we might be increasing our risk by the number of trades we take. That's what scalpers do. They take on less risk in duration, but increase the number of trades so they're balancing out the risk. Meanwhile, a longer term position trader might take fewer trades, so they have less risk, but their duration is much longer, so they have more risk there. It's just adjusting and shifting the risk from one dial to the other. That's why when people say, well, which is more risky? Is it day trading or longer term swing trading? I say yes. Because they're adjusting the risk. They balance it out and shift where it is. So, the length of the trade depends on the type of trading and which time frames you use. So, if you're day trading, you're obviously getting in and out in the same trading session, whether it's a few hours or a few minutes. Swing trading is holding positions several overnight at least to possibly several weeks. And that has, again, more duration. So the day trading has smaller duration, only inside during one day. Swing trading is holding over multiple days to multiple weeks. Then we have position trading, which is really doesn't have a time limit necessarily. Well, maybe 1 year, because traders typically don't hold beyond 1 year, taxation reasons, depending on what you're trading, of course. Futures are mark to market, so it doesn't matter. You treat it as if you were closing it out. So, what time frame charts should you be using? Well, there's not a set number that's perfect for everybody, unfortunately. I wish there were, it'd be so much easier, but there's not. So, if you're day trading, you might be using volume or share charts. You could use tick charts. Now, the difference is volume and share. Actually, let me see if I have open up my trade station here real quick, because they have all the different types of charting. Not every brokerage has all this type of charting available. See if anybody's logged in on that. Nope, looks like I'm good. And it'll take a moment to load this up. Bear with me 1 second. I just had to check on my ducks. They're out loose in my yard, grazing around, hanging out. All right. So, for instance, I'll use SPY, or it doesn't really matter. I'll use QQQ. Happen to be on a 5-minute chart, I believe. As soon as it loads up, there we are. And now, if I double click on this, I go into my chart. No, it's not where I wanted, is it? Time frame, customize. There we go. So we have time-based charts, which are minute, daily, weekly, monthly. That means that each one of those candles is one period of time. And irregardless if you have a trade, you still have to have a candle for every period of time that you've selected. But we can actually change this to volume-based, or what we call share-based. And that means when I click on that, it's 500 right now for shares. Every time 500 shares of this ETF is traded, we get a new candle. It has nothing to do with time. It's only based on the number of trades that have occurred, and in this case, shares actually traded. So you'll notice that sometimes one trade is 500. Sometimes it might take a couple of trades to get 500 contracts. But notice what's not happening at the bottom. It's not symmetrical. As a matter of fact, I'm looking at about 3 minutes worth of time, 2 or 3 minutes worth across the bottom there, because there's so much activity on this that we get 500 contracts traded pretty much in one transaction almost, or less than a few seconds. So I can adjust this, and then let's do 5,000. And notice now, again, we're only looking at about 15 minutes worth of data, but each candle, as soon as we get 5,000 shares traded, we get a new candle. No matter what time it is, it has nothing to do with time. It's just the number of candles traded or number of shares traded. So that is a tick chart, or sorry, share bar chart. It can be a little jumpy, but if you go to a much higher number, let's say I go to 100,000, it's not necessarily as bad. And I actually like these share bar charts because in a way you're looking at the imbalance of volume, buying and selling pressure when you look at these charts. And unfortunately, it's going to take a little while to load that up. Ooh, running a little slow here. There we go. But yeah, now we've got 100,000. Now we're looking at a couple hours worth of data, but everything else works the same. Supply and demand work the same. All the technical analysis charting works the same. But to me, this kind of displays imbalance a little bit better if you know what you're looking at. And I've done lessons on this in the E-mini Think Tank as well. The alternative, if you go to customize, is not based on number of contracts, but number of trades. Where's your customize? So here, if I go to tick count, that's the number of trades that occurs. And that's what's available on Thinkorswim is just the tick chart where it's the number of trades that have occurred. Or I can even look at it here on my trading view, I think. If I go in, I can go ticks, 1,000 ticks. This is 1,000 trades. So every time there's 1,000 trades on this S&P futures, I get a new candle. Or I can do 25,000. Oh, won't let me go that big. Nope, doesn't get bigger than that. Okay, so I have to upgrade. I'm not on that plan. Anyway, there's just different ways of viewing the markets, and it's your way of looking at that, whatever you feel most comfortable with. So for day trading, usually up to 30 minutes because you need to be in and out within the same trading day. You have to hit your targets. Swing traders hold overnight, so they're looking at a minimum typically of 30-minute charts and upwards. You could still use some higher share or tick numbers if you want and trade that way, but typically you're going to be using longer time frame charts, and that allows you to stay in a little bit longer, increases your risk, increases your reward. Position trading uses much larger times, typically 8-hour daily, weekly, monthly charts. You just look at the big picture, and what happens is the bigger picture you go to, the less noise you see. The small movements intraday or even intra-week, you're starting to filter those out and trading larger trends by going to those higher time frames. So depending on what style of trader you want to be, you choose the type of chart that will allow you to enter and exit based on what it is you're trying to accomplish. If you're day trading, you want to get in and out during the day, use small time frames, 5-minute, 15-minute charts. Get in and get out. So lower duration typically has less risk, and newer traders often want to go ahead and practice on day trading with lower time frames because it gives them more opportunities to trade and get practice, get experience. If you day trade, you also do not have to worry about overnight gap risk because you're in and out before the gap occurs. And that way you're protected. You're not holding overnight. Once you feel a little more comfortable with the longer term predictions and analysis of the markets, then you could possibly go to a larger time frame for duration and hold overnight. Accept that risk if you're comfortable. And if you're looking at volatility, you can actually deal with those small moves and see them better on smaller time frame charts. So if you're a newer trader trying to figure out, how trading really works and you want to get good experience, you get more on smaller time frames. I'm not saying you need to stay there though. So again, overall, we've got volume, which is the type and number of shares of contracts, the frequency, the number of trades you're actually taking, and duration, the length of time that you're going to be in a position. And everybody adjusts those a little bit differently to whatever whatever makes them comfortable and meets their criteria for what they want to be doing in the markets. And that's something that we need to discover on our own to figure out what we're going to be doing. So I said before, there's places you can learn, and obviously the one place I'd love you to learn would be the Mini Think Tank because we do have the education available there, as well as the practice that we do on a regular basis. So we're coming up on top of the hour soon. Kind of went through what I wanted to talk about. With the Mini Think Tank, basically, I'll just show you real quick. I've actually updated these. These are old, but I put out trade ideas. Some of them are shorter time frames, some are longer. As you see, we've got some 15-minute intraday trade opportunities. I've got 60-minute daily charts, and that still holds through to today. If I go out, let me see. Open. That's open earlier this week's the 20th. I don't remember what we did on that, but right here I have on a problem trip. Trade ideas for August 20th. That was Monday. And basically, first of all, I put in trade cancellations, why we would not take a trade. And that's very important too. Just because the trade idea is out there doesn't mean we're going to enter the position. As a matter of fact, we had 3 trade ideas on this page. Now, all 4 of them happen to be, 4 trade ideas on this page. All 4 of them were 60-minute time frames, but only one was actually entered. Here we have NE not entered. The reason why we hit our target before the entry. Same thing there. Here, the RSI was showing too much bullish momentum, so we canceled the trade. And all the rules as to why we would cancel trades are also spelled out, again, right here. And there's documents. This one was a win. It was a small win because we ended up hitting our entry, get halfway to the target, and we use a trailing stop. So we got stopped out based on trailing stop. And basically, we closed above the 8-period exponential moving average. Next page, you see we had 15-minute, 15-minute, 60-minute, 60-minute, and none of those trades actually hit. It happens sometimes. You get a lot of no trades. And this one also, gold on 60-minute was no entry. So sometimes it happens where we get in, sometimes it doesn't. Again, it's just a matter of what we see in the markets and what occurs. So any questions on running the risk radio or tuning the risk radio that you might have? You want to see the rules list? Sign up for the E-mini Think Tank. I also have color combinations because what I do in the trade ideas, did I close it out already? I think I did. If I go into my trade ideas, let's bring up another one. For instance, though, I put out the trade ideas, and in the trade ideas, not only did I put them out, but I also, oops, wrong one. Come on. There we go. So for instance, again, I had a bunch of trade ideas here. That one actually hit both wins on crude oil. But right here, I put out the charts. And with the charts, you'll notice I use certain color codes for different time frames. So for instance, 15-minute supply, this one actually was a 1-hour zone. I could tell by the color, and I actually have a color legend with all my charts as well. So whoops, right before the chart section right there. So it tells you what colors I'm using. So basically give you the trade idea, for instance, 4-hour swing trade on the micro NASDAQ. We were looking to buy at 23,671, 23,587. You can go to the chart. There it is. And you can see the area that I was looking at and how I set up for the targets using, in this case, Fibonacci extension. Sometimes it'll just be other zones, but it gives you the opportunity to find an idea and see that idea and plot it out on your chart, or even just go to that chart. Say, for instance, you saw the trade idea here, silver, 4-hour time frame. Go to your 4-hour time frame chart on silver, draw your own zones, and then go to the chart and use this as an answer key. Did you find the same zones I did? If you did, great. We're probably on the right track. If you didn't, figure out why. So it allows you to build your skills identifying what's going on in the markets. And I do lots of different time frames because there's a little bit of trading for everybody. It's pretty cool. All right. So any other questions? We're pretty quiet. Like I said, all this information is available in the mini think tank with the lessons and, of course, the live sessions that we do on a regular basis to give you more education and experience in trading the markets. So I'm going to call it for the day. I've got a bunch of things I got to take care of before the holiday weekend. Yes, have a happy holiday, Labor Day weekend. And until next time, everyone, trade safe, trade well, and take care. Thank you for being here.